All right, let's dive into Selective Insurance Group, or SIGI. This company presents a classic, almost textbook puzzle for investors. What happens when a really high-quality, historically reliable business runs head-on into a massive industry-wide crisis? And that's the core question we're tackling. We're talking about a company that's been a consistent winner for a long, long time. But lately, it's been absolutely slammed by forces completely outside of its control. So, if you're an investor looking at this, do you see a bargain or do you see a trap?
So to really get this dilemma, you first have to understand why people love this stock in the first place. The bull case, the optimistic view, is really built on two incredibly powerful engines.
Okay, so the first engine is their secret sauce, this philosophy they call high-tech, high-touch. The high-touch part is all about people. They literally put their expert underwriters right in the local communities to build these incredibly deep personal relationships with independent insurance agents. Then they back them up with the high-tech, all the slick, sophisticated digital tools that make doing business smooth and easy.
And what this does is pretty brilliant, actually. It creates this powerful competitive moat around their business. You see, that deep trust and partnership with agents, that's something the giant, faceless national carriers just can't easily replicate. It's truly the bedrock of their long-term success. Now, the second engine is just a massive tailwind for them right now. See, like all insurers, Selective takes the premiums you pay and invests that money. It's called the float, and with interest rates going up, the income they're earning from their nearly $10 billion investment portfolio is just surging. It's creating this huge and still growing stream of pure profit. So, we've got a fantastic business model, we've got this awesome investment tailwind. Sounds pretty great, right? Well, that's only one side of the story. Now we've got to look at the storm that has shaken this company right down to its foundations. And this storm has a name: social inflation. Now, this isn't about the price of milk or gas. No, this is about the exploding cost of legal claims. We're talking more lawsuits, juries awarding way bigger payouts, and just a general trend of finding companies liable for more and more things. For certain kinds of insurers, it has been an absolute nightmare.
The impact on Selective was, well, immense. Look at this number. That's the charge they had to take in 2024 alone, just to beef up their reserves. That's the money they have to set aside for future claims. It was a massive gut punch of a hit straight to their bottom line.
And you can see the damage crystal clear when you look at their combined ratio. Now, this is a super important number for insurers. Basically, anything under 100% means you're making a profit from the policies you write. As you can see, Selective went from being solidly profitable in 2023 to losing a significant amount of money on their core business in 2024. That's a huge swing.
But here's what's really telling. Look at how SIGI stacked up against its competitors. Their return on equity, a key measure of how profitable a company is, was less than half of what peers like the Hanover and Travelers put up in 2024. This just goes to show you how hard this storm hit Selective in particular.
So, you're facing a crisis, and it's hitting you way harder than your rivals. What do? Well, you don't just sit there, you fight back. And that's exactly what management did. They launched a strategic counterattack. And they didn't mess around. They came out with this three-pronged response. First, get aggressive on pricing. They started jacking up rates to get ahead of those rising claim costs. Second, tighten up underwriting. Basically, get a lot pickier about the risks they're willing to insure. And third, a strategic pivot, shifting their focus in personal insurance towards wealthier, more profitable customers.
So the big question is it working? Well, these decisive moves are definitely starting to pay off. Their combined ratio has already improved, dipping back below that critical 100% mark. They're back to making a profit on their underwriting, at least for the first half of 2025.
Which brings us right back to the central dilemma, right? You have a great company that got hit hard by a storm, but now it looks like it's starting to turn the corner. So for an investor, what's the bottom line here? What really matters?
It really all starts with the stock's price tag, the valuation. You can see the market is still pretty nervous. Selective is trading at a significant discount to its peers based on its price-to-book ratio. Now, that's the key metric for insurers because so much of their value is in their assets, like that big investment portfolio. A lower ratio means the market is scared, but that discount also represents a potential opportunity. So, for any investor trying to figure this out, the entire complex story, the great business model, the social inflation storm, the turnaround efforts, it all boils down to one critical catalyst. What is the one thing that has to happen for that discount to disappear and the stock to really work? It comes down to these three words: loss, reserve, stability. Investors need to see stone-cold proof that management has finally put enough money aside to cover all those future claims. They need to be 100% convinced that there are no more nasty surprises hiding in the numbers.
And that right there, that is the multi-million-dollar question. Has management finally, truly gotten ahead of this storm? Or is there still more bad news lurking just beneath the surface? For anyone looking at Selective Insurance today, answering that one question is absolutely everything.